Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, we've just released a monthly India market outlook titled Staying the Course. In this episode, we discuss a key question about the investor implications of the latest union budget and RBI's monetary policy announcements. Since peaking in September of 2024, Indian equities have been under pressure, driven by continued foreign investor outflows amid slowing growth, corporate earnings, and uncertainty around the impact of President Trump's policy priorities. From their respective peaks, the Nifty Small Cap Index has fallen into bear market territory, down 21.9%. Nifty Mid Cap Index is down 18.5%, while the Nifty Index has fallen relatively lesser, down 12.8% from the peak. The INR has also weakened against the US dollar, hitting several all-time highs amid the threat of a global trade war and a stronger US dollar. Given this backdrop, the growth-supportive budget and the RBI's recent liquidity measures are broadly positive for Indian assets. The union budget provides a much-needed fillip to domestic consumption through a sizable tax cut of nearly 0.3% of the gross domestic product, while propelling investments through public-private partnership and enhanced cooperation with states. Further, the budget took measures to boost employment and income through increased outlays for key employment sectors like agriculture, tourism, and exports. It also extended social security benefits to platform-based gig workers and also provided enhanced credit support for small and medium businesses and individuals. Now, what does this mean for investors? Well, we find the risk-reward has improved for Indian equities, supporting our overweight stance on the asset class. In our view, the budget sets a floor for the GDP growth amid a cyclical slowdown. A likely boost to aggregate demand from the budget should translate into improved corporate earnings performance that has lagged in the recent quarters. Earnings delivery in the recent quarter has been much better than expected, with the third quarter fiscal 2025 Nifty Index EPS delivery tracking above 10% year-on-year versus initial estimates of a degrowth. Earnings growth expectations for fiscal 26 and 27 is also at a robust average of 13%. In addition, valuations have also turned fairer, with the Nifty Index 12-month forward PE currently at 19x compared to his 10-year historical average of 18.2x and the recent peak of 21.8x. While volatility is likely to stay elevated in the near term, we would adopt a buy on dip strategy to add into equity. Coming to the bond market and the impact of RBI's recent policy measures, the RBI's Monetary Policy Committee lowered policy repo rates for the first time in 5 years by 25 basis points to 6.25% as it acknowledged the slack in domestic growth and easing inflationary pressures. However, the MPC retained its policy stance to neutral given risks to growth and inflation outlook from excessive volatility in global financial markets and uncertainties around global trade policies. The lack of any immediate liquidity boosting measures disappointed bond investors, with bond yields rising 3 to 5 basis points across the curve. Well, the near-term disappointment notwithstanding, we see the recent rise in bond yields as an opportunity for investors to lock in attractive carry yields. We see room for yields to decline over the coming 12 months, supported by easing financial conditions as the RBI cuts policy rates by an additional 25 to 50 basis points, and likely liquidity support similar to measures undertaken in the month of January through variable rate repo auctions and open market operations. Positive bond demand supply dynamics also are a positive given lower government net borrowing and improving foreign investor inflows. Finally, benign outlook on inflation with easing food inflation and robust kharif sowing. Overall, this reinforces our view of bonds outperforming cash in 2025. Declining yields, especially at the shorter end of the curve, is likely to raise reinvestment risks for cash and cash-like investments. We see opportunities in medium and long maturity bonds from a total return standpoint, giving attractive absolute carry yields and potential for price gains as yields decline. High quality or AAA rated corporate bonds also offer cyclically high spreads over government bonds. History shows corporate bond yields decline sharper than government bonds post the first rate cut, making them attractive from both absolute and relative return standpoint. Coming to the outlook on Indian rupee, the INR had nearly fallen 5% at one point since September after trading in a tight band for most of 2024. The weakness was driven by a confluence of factors: Expensive valuation, as the RBI's active intervention to manage currency volatility led the INR to strengthen on a trade-weighted basis against its peer currencies, with the real effective exchange rate for the INR rising to 108 in November, above the 100 fair value range. Strong US dollar was another reason, with the DXY index rising 8%, boosted by higher US bond yields as recalibration of the timing of US Fed rate cuts and a Republican clean sweep in the US election. Record foreign investor outflows from domestic equities, with USD 21 billion of outflows since October of 2024, and decadal low policy rate and bond yields differential with the US and India also weighing on the INR. Now, INR volatility is likely to remain elevated in the near term as President Trump's tariff threats and global trade uncertainty is likely to drive demand for safe haven assets like the US dollar. Over a 12-month period, we expect the USD INR pair to trade in a broad range of 86.5 to 88. That's it in this edition. Do reach out to your relationship manager for a copy of our India Market Outlook. You could also find it on the SC Invest section at www.sc.com/in or also on the Standard Chartered Market View on the Go page on our website.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.